We've been saying for some time that the risk to the economy is more on the side of deflation than inflation. So as COVID created all the destruction that it did and supply chains really being thrown off, we've been through a period here of inflation, which I think investors are baking into the cake. That's the underlying assumption out there, that we're in an inflationary period and that it was turbocharged by the supply chain disruptions that occurred during the coronavirus. Started in the business during the 70s. I was in college when inflation was raging. So I know what that is. And I truly believe we are not going back there, and that anyone planning for it is probably going to be making some mistakes. The bond market could be rallying because of what I just mentioned about money growth. I don't think many economists have observed, I haven't seen it at least, that the money growth rate has been cut in half from that 27% to 13.8%. Maybe the bond market is focused on that. But I will tell you, with the CPI reports that we have gotten, PPI as well, much higher than expected, I would have expected the bond market to continue to sell off and interest rates, therefore, to go up. Instead, since the end of March, the 10-year Treasury bond yield has dropped from 1.74 to 1.43, no matter how strong the economic data have been, how high the inflation numbers have been. And so the bond market is sniffing something out, I believe. Now, many will say, well, it's just quantitative easing. And I think quantitative easing was true at the beginning of this year and through March, when we went from 0.9 to 1.74. So nothing's changed.
It looks like the infrastructure bill will go through. As soon as the House passes it, it will go straight to President Biden's desk, and he will, of course, sign it. So no problem there. The problem is Speaker Pelosi is adamant that both bills, the infrastructure bill and the economic/social infrastructure bill, pass at the same time. And the reason for that is the progressives are adamant about it, and she needs to get the job done. I don't think that the economic and social infrastructure bill will go through. Maybe not until the midterm elections next November, not until those pass, because this election showed that policymakers are going to have to stay away from controversy. And there are a lot of tax proposals in the economic and social infrastructure bill. Many voters in the swing states do not like. Polls are showing they do not like them. And I think the election placed, my sense is it is now placing, from a politician's point of view, more weight on those polls. So the moderate Democrats want a full congressional budget office scoring of the bill to understand how much it really is going to cost. That is not going to happen for a few weeks. And it will take that long for the CBO to score it. So that means the infrastructure bill won't get a vote either if Speaker Pelosi still hews to the progressives' point of view.
So the three sources of deflation that we see, to go into a little more detail, on the innovation side, technologically enabled innovation, we are in a period today like we have never been, never. I mean, you have to go back to telephone, electricity, and automobile to see three major technologically enabled sources of innovation evolving at the same time. Today we have five platforms, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, all of which are deflationary, and not just by a little bit either. Jeff Gundlach and Howard Marks, and I think Stan Druckenmiller and Ray Dalio, all of them, I think, have been very, very concerned about a deflationary bust. And we agree with them in this respect. We think it's going to be balanced by a deflationary boom. So that's where we differ. But where we agree is that there are companies who thought the world would never change and have been, again, catering to short-term shareholders who wanted that extra penny or two in earnings, and so got it by having the companies leverage up and take more debt and shrink the number of shares. And they've also been focused on dividends. They are probably saddled with products and services that will become obsolete because of the record-breaking amount of innovation taking place today. One of the reasons is, of course, OPEC, and they have about 5 million spare barrels they could produce per day. They're not. They want to keep the oil price high enough so they can fund their budgets. But at some point here, they may end up killing demand. When they start seeing demand destruction because of pricing, I do think they'll start producing. And as you know, longer term, the combination of electric and autonomous electric vehicles, we think, is going to drive oil prices down. As I've said, now this is my point of view. We haven't done the research to get us here yet, but I think we could go back down to where oil prices landed after the cartel took over in the early 70s. And they went from, I think, $3 a barrel or $4 to $12 a barrel. Wouldn't be surprised ultimately to see us back there, especially as electric vehicles continue to take off. And they are starting to take significant share. Against, I think, the consensus expectation, the consensus short in terms of currencies was on the dollar at the beginning of this year. And the dollar is not going down. And that's also consistent with the bond yields coming down, surprisingly. So the three sources of deflation that we see, to go into a little more detail, on the innovation side, technologically enabled innovation. But I will tell you, with the CPI reports that we have gotten, PPI as well, much higher than expected. I would have expected the bond market to continue to sell off and interest rates, therefore, to go up. They want to keep the oil price high enough so they can fund their budgets. But at some point here, they may end up killing demand.